Ah, the fair value gap. You've probably heard of it, right? It's one of the hottest concepts in trading right now, and for good reason. When they work, man, they work like a charm. But that's the big question, isn't it? When they work. So let's really dig into this. Look, if you've been trading these, you know the feeling. You see a gap, it looks absolutely perfect, you jump in, and price just slices right through it like it's not even there. But then, other times, it hits the zone and just takes off. So what's the deal? What makes one work and the other one fail? And this right here, this is the whole story in one picture. On the left, you've got the dream scenario. Price pulls back perfectly into the gap and launches. On the right, well, that's the nightmare that keeps traders up at night. Price doesn't even slow down. The secret is knowing how to tell which one you're looking at before you put your money on the line. And that's exactly what we're going to break down. Okay, so to solve this puzzle, we have to start at the beginning. We need to be on the same page about what a fair value gap actually is. Think of it like this. The market moves so fast and so hard in one direction that it leaves behind a little pocket of inefficiency, an imbalance. And the market, well, it hates inefficiencies. It has a natural tendency to want to go back and fill that gap, to reprice that area before it continues on its way. That trip back, that's our opportunity. So here's the absolute key takeaway. The tool itself, the FVG, it isn't broken. The reason so many trades fail is because people are trading the wrong ones. They're trading invalid gaps. Your job isn't to find every single FVG, it's to become a master at filtering out all the junk and focusing only on the A-plus setups. And how are we going to do that? With a system, a checklist. We're about to walk through a simple 6-point validity check that you can run on any fair value gap you find. This is how you build confidence and consistency. And here it is. This is our 6-point checklist. First, is the gap unmitigated? How does the candle react when it gets there? Is there any confluence with other levels? Which gap has priority? Is it in a discount or premium zone? And finally, was there a break of structure? This is how we get out of the guessing game and into a real rules-based strategy. All right, step 1, and it's a simple one. The gap has to be fresh, virgin territory. If price has already dipped back into that zone after it formed, it's what we call mitigated. It's been tested. The magic is gone. We are only interested in clean, untouched gaps. Step 2 is all about watching the price reaction. So price comes back to your zone, a wick can poke down into it or even through it, that's okay. But if the body of that candle closes right through the other side of your gap, the trade is off. The setup is invalid. What you want to see is the candle body closing inside the zone. That's your signal that someone, buyers or sellers, is defending that level. Now we get to step 3. And this is where you can really start stacking the probabilities in your favor. You see, a fair value gap on its own is pretty good, but a fair value gap that lines up perfectly with a major support or resistance level, now you're talking. That confluence, that overlap, makes the zone exponentially stronger. Okay, so this is building up nicely, but even if a gap passes those first few checks, we have to understand that not all valid gaps are created equal. We need to learn how to spot the absolute strongest zones. This brings us to step 4, a really simple but super effective rule. Let's say price rips higher and leaves 2 or 3 different FVGs behind. Which one do you trade? Easy. You always give priority to the lowest one, the one closest to where the move started. And in a downtrend, you just flip it. The highest FVG is your prime target. For step 5, we're going to pull out a specific tool to help us with this, the GAN box. Now, don't let the name scare you. We're just using it to split a price move into 2 halves. You'll just need to go into the settings on your charting platform and set the levels to 0, 0.5, and 1. That's it. So here's how it works. Let's say you're looking for a buy setup. You draw the box from the bottom of the move to the top. This rule says you should only take trades on FVGs that are in the bottom 50% of that box, what we call the discount zone. It's like waiting for a sale. Any gap in the top half, the premium zone, you ignore it. And for shorts, you guessed it, you do the exact opposite. This one filter will save you from so many bad trades. And now for step 6. Honestly, this might be the most important rule of them all. The big, aggressive move that actually creates your fair value gap, it needs to have accomplished something meaningful. Specifically, it has to break a previous market high or a previous low. We call this a break of structure. It's the proof that the move has real power and intent behind it, making any gap it leaves behind way more reliable.
All right, enough theory. Let's see how this all comes together in the real world. We're going to walk through an actual trade setup, applying our 6-step checklist from start to finish.
So let's break this down. First thing we see, boom, a clear break of structure to the upside. Check 1. That move leaves behind 2 fresh, unmitigated gaps. Now we apply our filter, the GAN box. It immediately tells us the top gap is in a premium zone, so we ignore it. The bottom one, though, is right in our discount zone. Perfect. Then we notice it also lines up with an old support level. That's confluence. Check. Finally, we just wait. Price comes back, the candle closes inside our chosen zone, and that's our entry trigger. Every single box is ticked.
And what's the result? A beautiful, clean, high-probability trade. Because we followed our rules and validated every aspect of the setup, the zone held perfectly, and price ran straight to our target. This isn't luck. It's what happens when you have a clear, repeatable process.
So really, what this whole framework gives you is an edge. It takes you from a world of confusion and guesswork into a place of actionable clarity. So let's just hammer home the main points. First, not all FVGs are the same. You have to know which ones to trade. Second, having a checklist like this takes the emotion out of it. Third, that discount and premium zone filter, it's absolutely critical. And finally, always make sure that move is validated by a break of structure first. It really all comes down to this idea right here. You're not looking for one secret trick. You're combining all 6 of these simple steps to build the ultimate A+ setup, which massively increases the odds that the price will respect that zone. So the last thing I want to leave you with is a question. Now that you have a clear, step-by-step process for validating one of the most powerful concepts out there, how is that going to transform your own trading from here on out?